I think the American dream is to have peace.
Love, family, joy, peace, survival.
Being able to have security, whether that's in your home or your business.
Enjoying life, the little things in life.
All races, like getting along, friends, family, people that love you and care for you.
Big house, white picket fence.
Not having to worry where your next paycheck's coming from, where your next mortgage payment is coming from.
For me, American dream is to treat everybody equally.
Know that when you retire, that you're not going to have to work at Walmart to put food on your table.
To succeed in life and to get a good education.
Having the freedom to live my life pretty much the way I want to live it.
What do you dream about?
Money.
You do?
To me, the American dream is the ability to own a home.
The dream of home ownership in this country has been alive since the very beginning. While Thomas Jefferson drafted the Declaration of Independence, John Adams argued that the pursuit of property is one of our inalienable rights. Life, liberty, and the pursuit of property are rights that he said cannot be taken away from us. Of course, Jefferson substituted a more pleasing word, happiness, and the dream of a nation was born. At first, farmland was the most sought-after form of property. Then the population shifted to the overcrowded blight of cities during the Industrial Revolution. With the Great Depression came the Hoovervilles, dirty ramshackle shanty towns occupied by the unemployed and down and out. Surely for most, the dream of home ownership would remain just that, a dream. At the end of World War II, 16 million American soldiers returned home, most searching for a place to live. Out of this housing crisis rose one of the biggest home ownership revolutions in the nation's history. Levittown, New York, the nation's first suburb. Levittown provided affordable single-family cookie-cutter houses where a young couple could purchase a home with a $90 down payment and a mortgage payment of $58 per month. And that included the built-in TV that came with every home. And what about today? How much has the dream changed, and what does it take to live it?
In the old American dream, it's sort of like, to speak, everybody was kind of like even, because everybody was sort of on the same level and you rise together. But today, it's a lot of pressure for the young people to have to live up to that dream.
Everyone is reaching for that American dream to own their own home.
That's what we want for our clients. We want them to be able to participate in the American dream.
It's part of the American dream that almost anyone could own a home.
Just sign here. So I did.
I had the strangest dream, my God. I could see everything so clear.
One of the most important contracts that Americans will enter into in their lifetime is to purchase a home, and in doing so, take out a mortgage.
Our government is supporting home ownership because it is good for America.
Changes in the structure of the mortgage banking industry have made it possible for home ownership to rise to record levels.
This administration will constantly strive to promote an ownership society in America.
Land development, home building, home sales, refinancing, and what's fueled it all? An exploding mortgage industry. Along with this evolution and growth has come monumental debt and an industry riddled with abuses. Weekly news stories depict victims of unscrupulous lending practices and thousands of foreclosures daily. Although the mortgage industry has flourished over the years, homeownership seems more vulnerable than ever. To understand the roots of this vulnerability, we scrutinize the mortgage lending process from the very beginning. Do we fully understand the contract we are signing?
I think all of us, when we go into that room to sign that mortgage, we're more excited about getting the house, I think, than really understanding what we're signing.
Do we know the value of our signature?
Everybody knows that your signature is your own property.
Your signature creates the money.
Are we aware of the predatory practices that threaten home ownership?
It's very seldom do we find a mortgage transaction that actually is okay.
In the opinion of some who participated in this documentary, if these questions remain unanswered with no changes made, the American dream that most aspire to and seek to hold on to could become a thing of the past.
I've had some things happen in my life. You know, I lost my mother when I was young. That was tough. I've had other things. I lost my best friend 20 years ago. He died of cancer. That was a real rough thing. Maybe I have things out of proportion, but this was the hardest. This is the worst that's ever happened to me in my life so far. It's been my dream to design and build my own home that I would spend the rest of my life in. You know, a lot of people may look at a home as, you know, mortar and brick and wood and whatever, but our home was everything that I have ever wanted to have in terms of a family and a life. Well, I think the hardest part was telling my kids that we had to leave. You know, this was a house that we were never going to leave, that we were going to stay there forever.
The lack of any economic education in America is frightening. The fact that you can graduate from college without ever having any formal training in anything to do with actual contracting that you make all your adult life. The idea that graduating seniors from high school can't calculate simple interest rates.
Yet back in the 1920s, 6th grade textbooks had lessons in mortgages and how to calculate interest. And today?
High school, let me think. I'm sorry, it's been a while. I don't remember, unfortunately, what we learned in high school.
The only thing I've heard about, like, mortgage and stuff like that is about my mom saying, I had to pay the mortgage this month. Just always in a bad mood after that, so I'm taking it's not a good thing.
It really makes you think that the average American out there shouldn't be allowed to contract without somebody to help them along the way.
Especially when it comes to the mortgage contract.
If you talk about the average consumer, they walk away from the closing and they've got an envelope from the title company with a stack of papers anywhere from, 3/4 of an inch to 1.5 inches, and they never look at that stuff again. They just signed the most important transaction in their life, and they never even read this.
We understand that we're supposed to have our documents a full 3 days before we are to sign them so that we can review them. And I think maybe the 11th hour before we were prepared to sign, they were still printing.
Well, as a real estate lawyer, yes, I do explain to my clients, but the problem is most people don't go to a real estate lawyer when they're buying a house and filling out mortgage paperwork. They just kind of, someone shows up at their house with a big thick packet of papers and says, sign here, and they don't understand what they're signing other than, here's how much I'm paying a month.
You really have to read the fine print. There's a lot of stuff that you're signing and a lot of things that if you weren't in the industry, you wouldn't know what you're paying for all the time.
And do your clients normally ask you those questions, or do you guys give the information?
Oh, you have to ask everything. They won't, otherwise they'll have you in and out in 45 minutes and you won't know what you signed.
Part of the problem we see today is the brokers are in too much of a hurry to spend that kind of quality time with an applicant, and therein causes a lot of the problems we see today and the complaints we see today.
As a mortgage broker, we would spend as little time as possible going through. We would take a loan application and we would spend as much time as it was necessary to get them to sign the application, pay for the appraisal, and get the process started and go on to the next one.
If you put in 16-point type on the front page, if by signing below you agree we can screw you in any way we want, people would still sign it.
You know, I had a few questions, and he said, no, everything's basically just boilerplate. It's pretty much the same thing you've always done. Here you go, just sign here and here and here and here. So I did.
This industry is a real problem for consumers for a lot of reasons.
Yeah, it was our absolutely dream house. I was just happy in the home and doing homey things and redecorating and all that stuff and raising the kids, and to me that was it.
My dad had passed on and my sister and her children moved in with my mom, and it was becoming harder and harder to keep the payments going. So they had to refinance, and they did that with the same mortgage company. I believe it was originally Long Beach Mortgage, and it became AmeriQuest.
AmeriQuest, the nation's largest privately held mortgage company, is the country's #1 provider of mortgage loans to people with bad or impaired credit.
Not even 2 years after that, then things started to fall apart. They made some error in their bookkeeping or something. They had tacked on an enormous amount of hazard insurance onto the mortgage erroneously.
The insurance lady said, "What is wrong with those people?" She said, I've sent them a copy. I think that happened twice, and the third time she said, "I'm going to take it over to them," because there was no reason for them to do that.
This caused what they called late payment, or the overage to pile up every month, and it got worse and worse and worse.
And every time I called, I got a different person, and every person told me something different.
AmeriQuest would post the payment, and 1 or 2 days later, it would clear my mother's bank account. They did that like clockwork since the refinance. All of a sudden, they waited a week to post it, and then they waited 3 weeks to post it, even though they had the payment. And what that caused was like saying, well, these people didn't pay last month. You know, she didn't pay, she was late. And then they added it on, and she's thinking, my God, I can't pay all these, late fees and whatever. So I feel that they intentionally withheld the payment because they wanted to foreclose. Her payment due all of a sudden becomes $2,600 instead of $18. Then the next statement, it's up to $32. Next statement, it's gone to $58. And the statement after that, it's up to $8,444.51. And they tell her, if you don't give us this amount of money, that's it. And she believed them.
I can't believe that I'm crying after all this time.
Here. I had been running an errand, and I came home to the house to find her standing in the street with my dog on a leash, and my sister had the other dog on the leash, and the sheriff had thrown her out of her own house. After 31 years.
In January 2006, AmeriQuest in 49 states reached one of the largest consumer protection settlements in history. The lending giant agreed to pay $325 million in restitutions to more than 700,000 borrowers. AmeriQuest also agreed to reform its lending practices to resolve allegations that some of the lending practices it has used have been predatory. Most borrowers received as little as $600 from the settlement, and many are without a home to call their own. Still, AmeriQuest admits no wrongdoing.
Predatory lenders typically affect senior citizens, those on a fixed or lower income, or those with bad credit history. Now, predatory lenders actually prey on those who are more vulnerable in our society and force them to pay higher interest rates.
Bait and switch. I told you it was going to be a fixed rate loan. It's not. I told you it was 6%. It's not. Those issues remain to this day, and they're very difficult to litigate because all of the oral representations from the loan agent or the broker are whatever they were, but at the end of the day, you're sitting there with a bunch of signed documents that you're presumed to have read. And is that your signature? Yes, it is. Well, did anyone stop you from reading it? No. So what's your complaint?
Yield spread premium, that the borrower suddenly comes to the day of reckoning when they realize their interest rate is much higher than their neighbors or what they're seeing in the newspaper, and they go back and find out that, oh my gosh, my mortgage company made all this extra money on me for raising my interest rate.
Sometimes a point or two, It will raise the payment maybe as much as $200 a month that they're paying extra. And over a period of 360 payments, 30 years, it could amount to a substantial amount of money, maybe even in 6 figures. So we're talking about stealing quietly.
Perhaps the worst of all predatory lending practices take place in the subprime market. A subprime borrower's interest rate is often 5% higher than the prime interest rate because of their low credit scores. If you have a $300,000 mortgage, an extra 5% interest rate would raise your monthly payment by $1,058.32. That's a lot of money for these borrowers, many of whom are living paycheck to paycheck. There are a variety of lenders promoting these loans, but why? What do they have to gain?
The lender would make them a loan, a very high-risk loan that had a very good chance of not paying out over its term simply because of the circumstances of the borrower. This lender may be willing to make that loan based on the fact that even if they foreclose, in fact, maybe it's their plan to foreclose, that they come out on top because there's enough value in that collateral to have paid off the debt plus made them a little money.
According to reports from Fannie Mae and Freddie Mac, who own more than half of all single-family mortgages, approximately 43% of subprime mortgages should have been prime rate. And the majority of those victims are minority families. So unsuspecting borrowers with good credit overpay their lenders by more than $12 billion a year.
Are these loans good for people? Does it really help homeownership to put people out into loans where they're paying 50, 60, 70% of their income on the loan to own a home? Does that really improve the quality of life in America? Is it really a good thing? I think that is a real open debate at the moment, and I think with rising interest rates we might have a different answer in a few years.
Predatory lending is not the only way that lenders squeeze extra dollars out of unwary borrowers. The service that you receive can also affect your pocketbook and even cost you your home.
I did everything I could. I did all the right things, and it still came out wrong.
Robert McAdam builds and sells spec homes for a living. A 6-month delay on the sale of his spec home tightened Robert's budget, causing him to get behind on his home mortgage payments with Washington Mutual. Denied an extension on his construction loan, he requested a hardship package from Washington Mutual. They turned him down because he did not make enough money.
I had been behind for probably 6-8 months. I had been getting notices from the bank. They told me that they don't handle accounts that are in default.
Robert was referred to Washington Mutual's trustee company, California Reconveyance.
I finally got a hold of a woman named Terry Gibson and had said, I need my payoff amounts, Well, her response was, well, we don't have the payoff amounts, we have to get it from the bank. And I said, well, this is ridiculous. I said, I've got a loan with the bank, they're telling me I have to get it from you, and you're telling me you can't give me the payoff amounts, I have to get it from the bank. And she said, yeah. I said, well, how do I do that? Because my sale date's approaching in a few weeks, and I have enough money to get current so that we can get the loan, current, so you won't foreclose, and so I can keep my house. So I sent them a letter, I faxed it to them, called them right away and said, did you get the fax? Yes, we got the fax. It'll take us about a week to 10 days to process it, and we'll get you the loan amounts. They never gave me any loan amounts. They never contacted me in return. I called them. I have phone records. I have all sorts of records of my attempts to get them to allow me to pay off my loan. No response. None.
California Reconveyance, as it turns out, is located here in Washington Mutual's Northridge, California headquarters.
Servicing is a very low margin area. They get a spread on the interest rate. It's pushed down way low nowadays. So they don't make any money by responding to your request. They make money by collecting late fees and defaults.
By law, they have to give me payoff amounts. They have to allow me to get current on my mortgage. And they never responded. I guess I was naive enough to think that this wasn't going to really happen because they're going to give me my payoff amount. They're going to give it to me. They'll let me get caught up. They can't do this. They won't do this. But they did.
Are there any further bids? Come on. Yeah, come on.
There were about 20 bidders there that wanted to buy my house, that wouldn't say a word. They didn't want to get involved. But the one bidder that did was another bank.
Representative. It's Wells Fargo. What are you being so secretive about? Wells Fargo Bank, just say it. You know I'm doing my job, sir. Going once, twice, for the third final time. What you do? They're bidding for the bid. The property is sold to.
I contacted Wells Fargo Bank the next day and said, hey, I want to buy my house back. They said, too bad. We will not sell you your house, flat out, period. You will never live in that house again.
With a lack of concern from some mortgage servicing entities, many individuals can find themselves in temporary financial difficulties with no place to turn.
When my second son was born, he came out C-section. My wife had to take off more time than what she expected. She works for the government, so she doesn't have any maternity leave. You have to use whatever your annual leave you have. So we got behind on all of our bills, even our mortgage payment. Called my mortgage company and said, hey, I'm trying my best to get caught up. I need help. So what they decided to do was to restructure my loan. And in the restructuring of my loan, they said, okay, what we're going to do is we're going to take the note that's due, put it on the back end, and just start you off fresh. And I was like, thank you, Lord, or whatever, you know. And I'm telling you, this was maybe 2 or 3 days before we were at the process of closing this program out. They sold my loan to another mortgage company.
Many borrowers today, like Ken Owens, experience a change in ownership of their loan numerous times throughout the life of their mortgage contract. In Ken's case, this caused serious problems. He was now left to renegotiate with his new lender.
Right away, when I got the notice that my loan had been sold, I called that mortgage company and said, hey, you know, I'm in the middle of, you know, almost at foreclosure proceedings, and we're getting ready to restructure my loan, and I need you to pick up where they left off. Oh, no problem, sir, we got you. And so they started the process, and I guess they saw all the equity that I had built in my home, which is about $150,000, $180,000. And I guess they saw the money and decided that, you know what, it'll be more, better for us to let this thing foreclose and get the money, you know. So they did just that. They started the foreclosure proceedings again. I tried to do a quick sale, didn't have enough time, and ended up losing my home.
Several months later, Ken ran into his real estate agent, who informed Ken that the lender who had foreclosed on his home owed him the surplus equity from the foreclosure sale.
She says, hey, did you ever get your money? And I said, what money? And she said, well, the money from the surplus of your home, because they sold your house for this amount, and you only owed this amount. So the surplus goes to the last title owner. And so I called the company up, and I says, hey, you know, I heard that you owe me some money. Oh, we've been trying to find you. I said, well, you knew where to find me when you wanted your money, you know, so what's been the problem? And I said, let's get down to the nitty gritty. How much do you owe me? She said, oh, $35,000. I said, well, send me my money.
Borrowers don't even have to be in any financial trouble to be given the foreclosure runaround.
Here recently, we had one in Provo, Utah, where the judge actually called the client, the bank's attorney, because they didn't even bother to send an attorney to the hearing. The bank's attorney wasn't in his office. There was just collection ladies on the phone. So he finally gets a supervisor of a collection lady, and she says, oh yeah, it does look like they paid their payments here. And they had a foreclosure sale scheduled for the next day. And that's being a judge calling from court in a hearing. How do they expect the common ordinary person who doesn't have any clout, so to speak, how do they expect them to get actual results and answers from an agency?
Fortunately for this family, they were able to save their house. But for many borrowers, they find that they are unable to get help fast enough when it comes to unfair foreclosure practices, especially in states that allow non-judicial foreclosures.
Foreclosure in California, like many states, but not all, is called non-judicial. That is, the entity trying to foreclose on your property does not have to bring a lawsuit. They can simply file a notice of default against you.
If you have a forced judicial review, at least you can say, wait a minute, Your Honor, we have some questions here, and you can slow down the process. In non-judicial states, it's very difficult because all they do is they list it in the paper and post it on your door and sell it. And the only way to stop that is to go in and file in court. There's no review whatsoever. The end result is there are foreclosures that shouldn't have happened, and you can't prove it fast enough because the timeline on these foreclosures is really tight.
In California, this is a very fast process. There's basically a 3-month period in which you can cure, and then another notice gets sent to you, and then you have a couple weeks until the sale takes place.
They can take your house, sell it, without any court order, without any court action, and you are powerless to stop it.
In the first quarter of 2006, foreclosures in the United States were up 72%, bringing it to a rate of more than 100,000 foreclosures per month.
You try to go tell this story to people. You try to spend 5 months in a Motel 6, and all of your pets are at the vet, and you will actually meet other people who are going through similar things. But anybody else, they think you're crap, and they think that they think you're a bunch of losers. They think you didn't pay your bills.
Society has made us feel that we are someone if we own property. So you're almost made to feel like an outcast if you're not a property owner.
Even in the neighborhoods we've lived at, in this area, we have been looked down on because we were renters and not homeowners anymore. You realize that you can never judge anybody because it could happen to anybody.
One of my sons made a comment in carpool the other day that my wife overheard, and my son remarked that my dad doesn't have time for me anymore, which is very upsetting because I want to spend as much time as I can with my kids, but I can't anymore. I hope someday I can, but all that has been taken away because my house was taken from me.
Whether it's predatory lending, servicing problems, or unfair foreclosure practices, millions of homeowners face these abuses every year. And how bad is it?
As far as the complaints that come in, it's really astounding. You would think that it'd be 50-50 or 40-60. It's about 90%. It's very seldom do we find a mortgage transaction that actually is okay.
I would say of the 30,000 licensees of mortgage brokers we have, 15% are non-compliant with federal or state rules. Of that number, maybe 25%, or about 1,200 of the total, are seriously non-compliant.
There's been a 41% increase in the number of mortgage fraud cases opened by the FBI in the past year.
I turned on the news today. They had nothing good to say. And I thought, man, oh man, oh man, how will this world survive?
There's so many mortgage companies now and realty companies that are willing to get you that mortgage no matter what, because they're going to get that commission and they're going to get that money for themselves. It doesn't matter if you can afford it. It doesn't matter if you can afford the payments, or they don't care as long as they get their part of it, and then they're happy to foreclose on it.
Just how did the mortgage industry find its way into some of these questionable practices commonly used today?
In the mid-1900s, it was your corner bank lending. If you wanted to get that loan, you walked in, you talked to the banker, you knew them. They actually took their depositor's money and gave it to you instead of sending it somewhere else. And oftentimes you walked in the payment every month. Now, over the last 15 years in the United States especially, this entire process has been transformed. And
And what has happened is you now have not the neighborhood bank, you have not the banker that you know, but rather a giant mortgage lending industry, and that's exactly what it is. The entire basis for this is the ability to resell notes on Wall Street.
Prior to 1908, there was no federal statutory device through which private citizens' obligations could be turned somehow into money. In the pressure of the Great Depression in 1932, 33, and later, the statutes were amended to allow the reserve banks to make loans on any satisfactory security, which meant that they could lend on mortgages, for example. If the banks made new mortgage loans and in turn could borrow against those loans at the Federal Reserve, this was an obvious stimulus to having the system expand that mortgage pool.
The practice of making and selling a mortgage loan became much more vigorous in the 90s, actually the 80s and the 90s.
Wall Street was able to buy up all these mortgages, and it's very technical, but what they do is they get a pool of mortgages and then they slice and dice them. And they take, I know you don't want probably this detail, but they may take 100 mortgages and they will sell to one investor over here the first 5 years' payments on those 100 mortgages. Then they take the payments between 5 and 10 years and they sell them to investor B. By making 30-year mortgages into an investment product that's resellable out on the market, it provided huge liquidity to our banks. Banks are now able to make the loan in their community, sell that loan off, get the cash for the loan from the investors, make the next loan in that community. It's a really wonderful thing.
So it trades like a commodity. It trades like a bond. It's truly a negotiable instrument. And there became demand for long-term investments.
All of the funding for this ultimately comes from this incredible transformation where all of your notes are actually sent off into the ether oftentimes, owned by someone you've never met, and serviced by someone you'll never see. And what this means, in a real sense, is that lender has absolutely no interest in you as a person. They don't really care who you are, what you do for a living, why you wanted to buy the house, why you wanted to remodel it, whatever it may be. What they care about is that you make your monthly mortgage payments and they can sell your note on into the secondary market.
So today's a big day?
Yes.
Yeah?
Yeah, we're excited.
You know, we've reviewed it and I think that everything's in order here. Did you have any other questions about this?
Do you, honey?
No.
No? Are you ready to sign?
And so the promissory note you signed begins a life of its own.
First stop, Bank 1. Once I get the bank stamp, I can be monetized. So now I'm a form of money. Then I get bundled with several other notes and sold as a package to another bank. Yay! Bank 2 may repeat the process, stamping, bundling, and shipping me off with all the other promissory notes. And this could go on and on and on, stamping, bundling, shipping. Eventually, I'll accumulate enough frequent flyer miles to cash in on a round trip. But instead, like most of the other notes, I end up at Fannie Mae or Freddie Mac, only to be sold on Wall Street.
Filed away and used in an investment portfolio that pays for Grandma's monthly check.
As you can see, the mortgage industry is an extremely lucrative business to be in. Residential mortgage sales reached over $3.8 trillion in 2004. And in case you're not sure how much 3.8 trillion is, 3.8 trillion $1 bills stacked on top of each other would reach from Earth to the moon and over halfway back again. Although promissory note sales opened the door for more available loans than in our past history, regulation efforts have not been able to keep up with the enormous growth in the industry.
We can have all the laws in the world. If nobody is going to
really aggressively and vigorously enforce those laws, then it really doesn't matter. What you've got is a bunch of books and papers taking up space.
We contacted the Office of the Comptroller of the Currency, whose primary job is to regulate the banks. They declined an interview with us. However, this is what the experts are saying about the OCC.
The OCC does care about consumers and the banking public, because that's what banks are there for, is to service the consumer. But that being said, the OCC's primary focus is making sure that the bank is doing okay. And to the extent that they have funding, that's where the majority of their funding goes.
Just by virtue of the fact that the Office of the Comptroller of the Currency does business on a daily basis with the banks, who are incredibly powerful and yield incredible amounts of influence, compared to consumers who may show up with a complaint one time. A situation like that is ripe for abuse, and it's ripe for what I call, and what's known in the industry as regulatory capture, where an organization or an agency that has been charged with regulatory oversight of an entity, in fact, becomes, for all practical purposes, captured, because their self-interest ends up becoming aligned with the entities that they're supposed to regulate. And at that point, the consumers will always end up taking a back seat.
Homeowners like Robert McAdams and thousands of others are too often left on their own with few options and forced to fend for themselves.
I was not going to let everything that I had worked my life for just be taken from me. So I started doing a little bit of research, and I started finding out about the legal standing of debt collectors. And the more I researched that, the more my research started branching out into other things. Next of all, which was mortgages, and that's when I started researching with the bank system, reading books, some of the publications by the Federal Reserve System. It was very eye-opening. It was contrary to everything that I had ever been taught about banking.
The consumer believes that the bank went back into its vault and it took $100,000 from kind of a general fund and it moved it over into Mary Smith's account. And there's $100,000 there, which is used to pay off that previous mortgage, or to pay off the owner of the home so that you can buy it. Now the bank takes obviously a security interest in the home in the event that the consumer doesn't pay. At the end of that mortgage life, what you would assume is that that $100,000 has been replenished. Now let's look at what really happens. What actually happens is that $100,000 was never there. Like I said, it was a couple of keystrokes that were keyed into a computer someplace. At the end of the day, the bank now, where it had nothing before, has $100,000.
Is this possible? Let's take a closer look.
Meet Don. He deposits $110,000 into his checking account at Bank A. Bank A then creates a demand deposit account to offset the $110,000 asset from Don. According to the banking textbook, Money and Banking, demand deposits are funds that customers may withdraw from banks with no advance notice, like your checking account. Bank A is a member bank of the Federal Reserve System, so it may participate in fractional reserve banking. This means that the bank must keep a percentage of its assets in reserve in case people want to withdraw their money. In 1980, legal reserve limits were reduced to almost zero. But many banks do keep about 5% in reserve. The rest can be used to create new loans. So, if Bank A keeps 5% in reserve, they can now loan over $100,000 of Don's original deposit. The Bradleys need $100,000 to purchase a house. So they sign Bank A's promissory note. The promissory note you sign is like an IOU. The Bradleys promise to make monthly payments in exchange for a loan from the bank. If they default on their promise, the bank will take their home. Bank A accepts their signed promissory note as an asset and creates a demand deposit account in the Bradleys' name. The Bradleys exchanged their promissory note for a $100,000 check payable to seller Tom. Tom deposits the check in his bank, Bank B, and Bank A then transfers funds to Bank B. Using fractional reserve banking, Bank B may now exchange 95% of Tom's deposit for buyer Mary's promissory note for a $95,000 new home she wants to purchase. After receiving Mary's promissory note, Bank B, on buyer Mary's behalf, gives seller Bob a check for $95,000. Seller Bob deposits the check in his bank, Bank A. Before the Bradleys' initial loan, Bank A had Don's $110,000 deposit and Bank B had nothing. After the loans, Bank A has $205,000 in assets and $205,000 in demand deposit accounts, and Bank B has $100,000 in assets and $100,000 in a demand deposit account. The banking system has created $190,000 in new bank credit money as a result of the demand deposit accounts created from the two promissory notes. If they repeat the cycle a total of 10 times, the banking system creates over $800,000 in bank credit money that it did not have prior to the original $100,000 loan. With, say, an average interest rate of 6%, they make over $1 million in interest over 30 years and get paid back the principal in cash, even if they made the loans with credit money. If the bank sells the notes, they could make over $800,000 in cash from the credit created from your promissory note, all with minimal or no risk to the bank.
Some professionals question whether this is a fair practice and whether individuals are fully aware of the value that they bring to their own loan transaction.
What is your promise to pay? Your promise is your commitment to the bank or somebody else to use your time, your resources, your labor, your intelligence, your special skills to produce an amount of money or some other valuable commodity in order to pay someone back for having given you a valuable commodity. What people don't understand is that the bank never worked to earn the money that they say they loaned you.
See, as a banker, I don't loan money. I loan the credit of the bank. In other words, I loan money of account, but then I ask people to pay me back with money of exchange. So at the end of the day, when I add up my statement of condition, by the stroke of my pen, I've literally increased the size of my bank by $100,000. It's what we call PFA banking, plug from air. At that moment in time, the borrower is actually funding their own loan.
Logically speaking, if you loan somebody something, you're giving up something. So how do your assets and liabilities both increase the size of your bank when you're making a loan? It's not logical, it doesn't make sense.
It's really easy to pick on one side of a transaction and say, well, that's not fair. But let's take the other side. Let's say you borrowed $100,000, you paid it back over 30 years, so you got to live in this house for 30 years and you paid back $300,000. Now you sell the house for $500,000. Are you going to write the bank a check for part of the extra $200,000? No. Your benefit came from owning the house, which may or may not have appreciated in value. The bank's benefit came from lending you the money. I mean, we're talking big boys and girls here. Everybody went into this transaction with their eyes open.
Or did they? Some believe that borrowers are never given the chance to fully understand the mortgage contract.
It's what's not said. I think that is really the bigger issue here. If there were full disclosure of all the material terms in this, and there was true reform in the banking industry so that people understood that if they chose to come forward and involve themselves in a transaction with the bank, then that would be fine. But when you hold things back and you don't disclose that, and these are material terms that would expose to the people of this country what the real value of their signature is, what the real value of their promise to pay is, I think that if you really expose that to the people, like I said, there would be riots in the streets.
First reaction is I got angry.
to see that they were taking my signature and turning it into a monetary form for themselves, but I'm getting no benefit from it other than having to pay them extra interest.
I, like a majority of people out there, believe indeed when you walked into the bank and you acquired financing to purchase a home, there was actually an investment made on their part in me.
I grew up with that. It's like, yay, get tax write-off and you get equity. That's the American way. And when we signed the documents, and away we went. And we went home and gave each other high fives. And
I had no idea we'd funded our own loan. and a disbelief that this lie could be so well covered up, and everybody believes it, even up to the banker himself believing that he actually loaned you the money, because this information is kept so far away from the public.
The value of an American's promise to pay is immense, and it is actually running the entire world economy's engine. If people understood that, then obviously in any normal commercial setting, they would demand to have more compensation for that value.
I signed a promissory note, my signature is on it. Who's getting paid? It wasn't me. So there's fraud somewhere, and I'm gonna get to the bottom of this.
This information has led some individuals and groups to challenge the current system. They believe that most mortgage transactions are fraudulent from the start.
When I started looking around and realizing what was going on, and realizing that history proves that this is fraud, you got to stand for something. The truth is the truth. And I realized that if I didn't take a stand, you know, there wasn't a lot of people out there who had the knowledge who could.
I was told all my life that the bankers were right, the government's right. You don't go against them. You don't go against the IRS. You just don't question the system. And Bill has shown me that the system is questionable, definitely.
The arguments they use to challenge the mortgage contract vary. Some say lenders are guilty of violating various lending acts.
We have paralegals to go through the papers, and they'll find all the causes of action that present themselves in those papers. So we then tell the client, you know, what possibilities there are for them, and then they get to choose if they want to go forward or not.
Others claim lenders violate the Uniform Commercial Code, or UCC, which most states adopted to govern contract law.
The first thing that I realized was that only one party signed the alleged note. And if it's a one-party agreement, I'm kind of curious how an interest would have been compelled by the bank into a one-party agreement that did not include them. My signature is my property, which everybody knows that your signature is your own property. And because my property was the only thing on this piece of paper, I would notify the State Department via the Uniform Commercial Code, known as the UCC financing statement, that I was making a claim to any and all of those funding sources to those account numbers.
And then some believe lenders violate generally accepted accounting principles, which corporations, including banks, must legally follow in order to remain fair to their shareholders.
No one can ever produce those records. Never. And I can't answer why. I mean, you can request it all you want, but you never see it. I have not seen one case where somebody actually turned over accounting records to an alleged loan.
We have the ability to pay it back. That wasn't a question at all. Our backs weren't against the wall. It was a matter of, let's have this discussion about the legitimacy or the validation of the alleged loan.
When consumers take questions directly to their lenders, they can be met with resistance.
They acted totally in bad faith. They didn't want to talk to me. They said I'm frivolous, I'm crazy, and I didn't know that the definition of crazy was simply just being confused and asking them what they in fact truly did and show me the documents that you base your allegations on.
A year later, in a bankruptcy creditors hearing, the same questions were asked and again met with no response. This particular case was settled without the alleged borrower ever meeting a judge. And a few weeks after the hearing, a discharge of debtor notice was received in the mail.
The property and the house still sit in Traverse City, Michigan, untouched by anybody. There's not encroachment. They're not telling me they're going to foreclose. They just quite simply left.
Why would the lender just leave? Were they not able to provide answers? Or would speaking up expose undisclosed aspects of the mortgage transaction?
I'm Peter Johnson with the Dorian Group, a whistleblowing company dedicated to exposing the truth in the mortgage lending industry.
Dorian Group is a mortgage challenge company. It was formed to challenge just primarily real estate loans and notes on the homes. We're a company that believes there's an inherent fraud in the contract, and we go through a process that helps us determine that. With the homeowner actually has gotten involved in a mortgage that's fraudulent.
The promissory note is equal to an asset. The house is equal to an asset. Dorian Group is actually looking at the rights associated with the promissory note. What are the bankers doing with it? How are they obtaining the rights? Did they really obtain the rights? Are they lying to us, or are they telling us the truth?
The promissory note that the borrower, alleged borrower, ends up signing goes into the bank on their books as an asset. So actually the bank's asset column increases by the amount of the alleged loan. So there's a deposit that takes place there. And what they're doing is they're hiding that or concealing that from the client or the alleged borrower, that deposit, and they're only showing them the liability.
They write to the bank and say, it appears as if there might be some fraud or concealment.
Was there full disclosure in the agreement? We wanted those questions answered. And so we found the process or the service providers who would ask those questions on our behalf.
What's there to hide? What is so wrong with me wanting to just see the accounting records that show that your cash position was reduced from giving me that mortgage loan? That's all I'm asking for, and under the law, you have to give it to me.
The Dorian Group sends a presentment to its clients' banks with a bond to cover twice the amount of the loan, asking if the bank is able and willing to discuss their bank transaction, how the loan is funded, and who has entitlement rights.
All you have to do to collect full payment is come in with clean hands. And if you don't do that, then you have to be admitting that you can't do that.
According to the Dorian Group, the lender's silence affirmed that there was inherent fraud in the mortgage contract and that they were hiding it from their clients, and this leads to grounds for termination of the contract. We attempted to contact many lenders ourselves. None would speak with us.
The banks aren't loaning us anything. As a matter of fact, when you signed the promissory note, you created all the money that paid for your property. Go home, you'll just enjoy your house. What they'll do with that is they'll turn that over like it's a check, and they'll sign it. Now it's become their property, and they still want you to pay money for that with interest for the next 30 years, even though you've just paid it with your signature. Your signature creates the money. This is what Wright-Patman says in the in the congressional record. This is what many of the congressmen speak about in the congressional record. It's right there. This is what it does. It's created by the signature. So now they have title to your property, and they have that as collateral, which also can be monetized on the international market. So they take your property and make money with it while you're trying to live in it and pay for it the second time. Where's the morality in that?
They say, well, you're getting something for nothing. And I think about all the people that have been wronged by the banking system, where they've taken from the people that belongs to them, the equity that belonged to them. And I think of my grandpa, my great-grandpa. He worked in the mines, and he carried a board at a time home to build his house. And I think, well, his great-granddaughter will be getting back some of that equity that was taken from him.
The idea that the client, our client, is getting something for nothing is absurd. It's ignorance on the part of the people making the statements. Why won't the banks show these FBI agents and these other people the general ledger then? Why won't they show the client that? Why, when we set up appointments, won't they disclose the books? I thought we were being honest here.
Regardless of the process, these individuals and groups believe the current system is stealing people's assets and putting them in financial slavery. And for Robert McAdam, the Dorian Group was his last hope for saving his home.
As I became more and more educated, I started communicating with some of the people, explaining to them some of the issues that I was having. And they told me, they said, you know, your house is, you know, has been foreclosed on. You're not in the house. But we knew what we were doing was right and what they were doing was wrong. And if we could prove it, then there wouldn't have been an issue.
Mortgage elimination scams have been around since the 1960s, and in every case, they claim to be able to eliminate your debt for a fee. And these claims are always based on the illegitimacy of the United States banking system.
What the mortgage elimination people are doing is trying to tell you that you can take the bank's money and not repay it. And they're not trying to tell you this for a philosophical reason. They're telling you that they have a secret way of doing this, and they'll only tell you if you write them a check first.
Around the country, legal action has been taken against many mortgage elimination groups, who are seen by authorities as yet another threat to homeowners, leaving many out thousands of dollars, and some may even lose their home.
For example, if it's a single homeowner, the FBI will not get involved. If, however, there's a conspiracy and several homeowners are being defrauded, we will get involved. In these kinds of situations, state lines are almost always crossed, and the FBI is really the only way to pull all those strings together to get a picture of what's going on.
Are all of these groups just taking people's money and not providing a service? We found that some groups are working very hard for their clients, but whether their efforts will ultimately be successful remains to be seen.
In February 2005, 30 armed FBI agents raided the Dorian Group's California offices, walking out with 175,000 documents.
It was known that the FBI was investigating this effort and that this organization had offered the FBI any information that it needed, but the FBI would not speak with the group here. And instead, what they obviously did was they came in and they used a show of force.
This one agent was the yeller of the crowd, and he was saying, I can't let you go up there by yourself because you might pull a gun out and you might do something, you might kill us, you know. He was definitely trying to intimidate me.
They had to check for guns in our desks, and I have no gun. I have a pen and a keyboard, and that's what I'm doing to prepare documents to send to the court to check out the validity of certain mortgages.
Every day, the Dorian Group sends a package to the FBI for them to see what business they did that day after the raid. They just return them every day. They won't even open them. I don't know how much more disclosure you can give than that.
They never asked, number one, to see the books and records or asked to come in and see or to have us openly disclose prior to just coming in with a warrant. So what they typically do is they come in and they take all the books and records because they want to take all this information. They want to build their indictments where they don't have proper evidence to do it. Then you have no evidence to present in your defense. So they're controlling all the evidence that comes into the case.
In May 2005, the Dorian Group filed a complaint with a federal grand jury in Northern California, asking them to investigate the banks. Coincidentally, on the same day, they were served with a fugitive warrant from the state of Utah, charging them with multiple counts of fraud and conspiracy.
The FBI has come in, closed them down, seized their assets. So what they have done is they've been judge and jury for this group and shut them down before they were able to prove their point. There has actually been no trial against these people yet. There's charges filed, yes, but no trial. But they've been convicted by the media and the court system before there's been a trial.
My biggest fear is that they're not going to get their day in court. That's what scares me. That's the only thing that scares me.
After 6 months of incarceration and no trial, the Utah charges were dropped against Heinemann and Johnson. However, their troubles were not over. In September 2005, they were served with federal indictment charges from the Northern District of California.
When you can threaten a guy with locking him up and taking him away from his family and you know, capturing his resources, and you can't change his mind, that guy's a dangerous guy. We're not a mortgage elimination company. We're a mortgage challenge company. If there's an issue or if there's a real valid mortgage, then we're not going to touch it.
The only reason that we're in existence is because we're poking at the sore, saying fix it. We're not here to overturn 80 million mortgages.
They say their incarceration has crippled their ability to assist their clients in completing their mortgage challenge process. As a result, hundreds of the Dorian Group's clients have been losing their homes to foreclosure.
Their homes were taken from them lawlessly, and again, our staying in the fight is going to be their greatest asset. That we plan on doing, staying in the fight.
If you've been placed outside of your home, have you lost your home? No, you have not. If your home has been sold on the courthouse steps, have you lost your home? No, you have not. Why? Because if your home was fraudulently sold, okay, fraud is something that can be gone back on at any time if you can prove the fraud. And everything that took place because of that fraud is unwound.
You know, what we understand in the way of knowledge, the evidence that we have, will show that the people who are accusing us are in fact the criminals. I've been kidnapped and held hostage. One thing they don't want to have occur is the light being shed on this.
If you've got a group that is out there that's really critically looking at this mortgage industry and is exposing the flaws associated with that, and exposing the damage that's being caused by those non-disclosures, and then assisting people in going back and demanding that disclosure and demanding compensation for the damage that's been done to them, that industry is performing a vital function.
Americans are not the only ones questioning their banking system. In Canada, John Dempsey, a criminologist and forensics litigation specialist, is leading the first and largest class action lawsuit against Canada's national banking system. The suit alleges that the defendant banks force customers to pay for something they never receive and then seize customers' property when they are no longer able to pay the banks back with cash.
The best quotation that I ever heard about money was from J.P. Morgan in 1912 during the currency hearings. He was asked, Mr. Morgan, what is money? And his reply was that gold is money, everything else is credit.
In 1913, the Federal Reserve System was created. It was presented to the American people as the central bank of the United States, formulating and regulating our monetary policies, its primary duty being the control of the nation's money supply. Contrary to what many Americans may believe based upon its name, the Federal Reserve System is not part of our federal government. Although the Federal Reserve Board of Governors is a federal entity, the Federal Reserve System is made up of privately held member banks and is therefore owned by the shareholders of those banks, who are not even necessarily Americans.
They committed all of the assets of the American people to back the Federal Reserve. When people talk about the Federal Reserve or the money system in our country, they say, well, that's backed by nothing. Well, it isn't backed by nothing. It's backed by the full faith and credit of the American people.
I think the total credit in the economy is about $30 trillion, of which about $10 trillion is mortgage credit.
So 1/3 of the total credit in this country is created by your promissory note. Our labor, tax dollars, and property back the government debt and the Federal Reserve notes we use as money today.
Money can only be created in this economic system by debt, whether it's national debt or personal debt. Only when people become indebted can there be money be made.
We have right now, we have a domestic debt of in the neighborhood of $17 trillion. Now, what does that mean? That's the federal government debt, that is the state, county, municipal debt, corporate debt, mortgage debt, and consumer debt, all put in one big pile. The money supply is roughly 10 to 11 trillion less than the amount of the debt. One of two things can happen. Either you will have a collapse of the economy, you'll not be able to pay back the debt, because of default, or you will always have to go and create more money and credit to pay back the banker.
When I was a child many moons ago, you didn't hear this refinance, get a new loan. You heard a lot of save for a rainy day.
Growing up, you know, your parents basically teach you, you know, go to school, get an education, get married, and go into debt. And that's basically what we were taught.
If you can place everybody in the country into debt, you have slavery. You have no freedom when you're in debt. And so they pull the strings. They really do pull the strings. And that is detrimental to our entire economy.
See, this debt is like a herd of cattle. It's eating and drinking every day. It has to be serviced. And it's earning interest. And when you have a banking system that has a monopoly on the creation of paper money, you're always in bondage to a system. You can never get off the treadmill.
Because our national debt is backed by the American people, the Federal Reserve banks risk practically nothing. And since all past attempts to audit the Federal Reserve have been denied, it is impossible to know to what degree the member banks have profited.
Who owns the nation's monetary system? It doesn't belong to Congress. They write the standards. It doesn't belong to Federal Reserve people or to the commercial banks. They do day-to-day operations. So it belongs to the American people. Now, if the American people own this system and it generates trillions of dollars, why aren't they getting their fair share?
We're brought up with the perspective that the banks are legitimate in everything that they do, that the banks have a very high stature for a reason, that the banks operate reputably and honestly.
And I can tell you as a banker, every bank document is construed in favor of the banker.
A bank customer doesn't have any real power to go in and negotiate with the bank. Going to get the service they desire is to just give in.
What we have to constantly remind that to corrupt at the highest levels of government.
In the case of mortgage lending giant Ameriquest, heavy campaign contributions to President Bush and his political efforts may have played a role in getting Ameriquest CEO Roland Arnal a political position as ambassador to the Netherlands. On the same day he received the nomination from President Bush, Ameriquest set aside their record settlement for predatory lending. We can buy practically anything we want because we have almost limitless fractional reserve banking creating endless credit. We think we have it all, but how long will it last?
I'm so scared that I can't hang on, that I can't earn enough money to hold on to what I have, just to what I have. Today, I wonder how the hell I'm gonna keep it together. I can't work, I can't go back to damn tired. My husband's been working 2 jobs. I mean, it's starting to be the current.
The Federal Reserve increased the money supply by 62%. What was happening back? Pledging and borrowing, thinking the good times would never end. And then at the time of the crash, the Federal Reserve drained the money supply. In other words, there was not enough money to pay back the debt. And those that had pledged their farms, their homes, their cars, their stocks, their bonds, they lost it all.
One of the bigger risks today is the fact that there's so many second notes. Those are tied to prime, folks. Those go up in a month. Every time the Fed raises that rate, that goes up next month. It's not a delay factor. There's these adjustable rates that are fixed, the 5-1, 3-1, so on. There's the interest-only ones. If rates jack up the way they did, it's well within our memory, there's going to be a huge increase in foreclosures.
If the bubble pops, if we have a real estate crash and 50% of the values go down and people start to wake up to this and now they see, oh, now I see what they did, then that might be another story. But right now, if somebody wants to buy a house and they don't know how else to do it, does it matter to them if the guy fractionalizes the note illegally? He probably doesn't care.
Just give me the Super Bowl and my beer and my chips, you know? Just give me something normal. You know, I got kids to take to soccer practice. You know, I don't have time to do all this learning about the law. They don't know that if times get bad and the value of property is reduced, the housing bubble bursts, that what they have, what they think is a safe mortgage and a safe home, a safe refuge, won't be safe anymore.
From predatory lending to questionable or billions of dollars a year.
You know, buying a home or refinancing. You almost have to be a lawyer to understand all of this, you know what you're doing.
Really be educated as much as you could educate yourself about all of the fine particulars of everything about real estate, about, you know, land values and property values and zoning and everything. I mean, you practically need to know all this stuff yourself in order to survive.
One of the most effective ways that we can see change come to the current situations is when community becomes involved. The house behind me was foreclosed on in unscrupulous manners, but the Berkeley community that surrounds it has come together to discourage any buyer from purchasing the home and bringing profit to those who foreclosed on it. If you're in a foreclosure situation, demand that the foreclosing entity produce the original promissory note. According to recent court decisions in Florida, the promissory note must be owned by the foreclosing entity.
Before you sign anything or pay anyone any money, call people in your state that you think are in a position to know, the Attorney General's office, call the FDIC if it's a transaction dealing with a bank. Call the Better Business Bureau. Don't sign anything, including your personal check, until you are sure that the transaction is one that is going to be to your benefit.
Well, go find a bank that does not sell its mortgages into the mortgage market. That's one thing. And you'll typically find in most states one or two large institutions that in fact do not sell their mortgages. But that's the problem. It's usually only one or two in an entire state.
The one thing that I think would help is to have mandatory education programs prior to entering into a mortgage transaction. I think it would also be helpful to have mandatory mortgage audits to make sure that the mortgage transactions become more transparent, and where there are abuses that they're easier and faster to remedy than having to necessarily file a lawsuit.
The ways you make change are through legislative reform, because of consumer activism and because the media has shined a spotlight on fraud. And once the fraud is exposed, then the people have to make restitution. And that's the very nature of our system.
If there's any place where individuals and the government need to work together, it's in developing a system or a structure that can educate consumers before they get into a mortgage transaction about exactly what these terms mean and exactly what kind of a relationship that they're getting into beforehand. If we did that, I think that what you'd see is a lot more calls for reform in the mortgage banking industry.
A good remedy for all of this problem could be the appointment of a new National Monetary Commission, sort of like what was done in the years leading up to 1913 when the Federal Reserve was created.
Go back to the Constitution that provides that Congress shall coin the currency and regulate the value thereof.
But one of the simplest ways to take down the money changers is don't participate. Do not borrow. Don't use your credit card. Don't go into debt. Get out of debt. Stay out of debt.
My advice to protect their American dream, their home ownership, is to get involved, to learn what you need to know in order to give Congress the proper instructions.
If enough people go to their senator and their congressman and say, you're not coming back here unless you fix this problem, then yeah, that'll get fixed. You know, again, if you're cynical like me, if enough people that paid campaign contributions go to them and tell them that, then it'll get fixed.
I think that nothing will happen until you have a large enough display of unhappy mortgage borrowers exerting some political pressure on the system.
What we've done is open the door for you to look a little deeper. Ask the questions, do the research, take your own actions.
Like a